Facts. In this video, we're going to discuss a concept that's critical to the recording aspect at the end of the period. We're talking about adjusted entry. So although it's very complicated for many to understand, I will give you the foolproof tips needed to run through this with ease.
What are you saying?
So, before we get into the adjusting process, let's do a quick recap of how the flow is with the accounting process. Throughout the majority of the period, we're going to be focusing on the recording aspect of accounting. That is, making the recordings into the journals of the transactions and posting those transactions into the ledger. Now, we know that the second part of the process deals with the financial statements being reported to the public. But before we get to that, we have certain accounts that must be adjusted. Now, think about it, gang. When we're talking about accounts being adjusted, accounts can only get adjusted two ways. They could either be increased or decreased. And so that pretty much summarizes the adjusting process. It occurs at the end of the period, the recording period have you, right before we generate the financial statements. The adjusting process is very critical because it allows us to adjust those accounts before they are reported on the financial statements. If we didn't have the adjusting process, certain accounts on the financial statements to the public would be overstated, higher than what they should be, or understated, lower than what they should be. And so with that being said, we have 5 types of adjusted accounts that we're going to talk about. Adjusted entry number 1, prepaid expenses. So, prepaid expenses can be very misleading with the title, right? But I want you to break it down because remember, keywords are critical in accounting. Prepaid expenses. So watch the definition that I'm going to provide with you for a prepaid expense based on the title. Prepaid expenses occur whenever you prepay on an expense in advance. Keywords out of there. Prepay on an expense and advance. So the fact that you paid on an expense in advance means that the expense did not happen yet. So that's why prepaid expenses actually aren't expenses, because those expenses didn't incur. Consider rent being an expense, of course. What if we were to prepay on rent in advance? Well, rent expense hasn't happened yet, so therefore the prepay on that expense is not an expense category. So I wonder what that is.
My spidey sense is tingling.
Well, remember we have a particular account category definition that describes future benefits. And the fact that we prepaid on an expense in advance gives us a future benefit. And we know any resource that provides a future benefit to us are assets. Therefore, prepaid expenses aren't expenses. They're actually assets. Adjusting entry number 2, depreciation. Depreciation should already be a familiar term to a lot of you guys watching. Why? Because we've heard about depreciation in terms of the vehicles that we've driven in or own. And what do we know about depreciation? Well, we know that depreciation of a vehicle lowers the value of that vehicle through time. In accounting, the concept is simply the same as well. However, we only depreciate certain types of accounts. What accounts do we depreciate? Long-term assets. So, certain long-term assets are depreciated. Why are they depreciated? What happens is, through time, these assets that we own because of wear and tear will no longer be as efficient and effective in helping generate revenues. Therefore, the value of those particular assets must be going down through time. So that's what depreciation is. It's an adjusted entry that affects the value of certain long-term assets to go down through time based on wear and tear. And so with that being said, we have several ways to calculate depreciation, but that's further down the line, gang. At this point, I just want you to understand the definition of depreciation. Adjusted entry number 3, accrued expenses. So, accrued expenses by definition, what are those? I'm going to give you the short and sweet version so it can help you understand the adjusting process in itself. Accrued expenses are simply expenses that have incurred, also known as happened, but have not been paid yet. Which means that we still owe on these expenses that happen. And if we owe on these expenses that happen, we know that we have to create a liability. So anytime that we're dealing with accrued expenses, the expenses have happened and so a liability as well. Adjusted entry number 4, accrued revenues. So, accrued revenues are almost similar to accrued expenses, but just on the opposite end of the spectrum. So by definition, accrued revenue is a revenue that has been earned. Remember, gang, revenues are earned either by providing a service or selling a product, but the cash has yet to be received. And so we understand that once we provide the service or sell a product, the revenue is earned, therefore it should be recorded. However, in a lot of circumstances, cash has not been affected yet. And we know that if cash hasn't been affected after we've provided a service or sell a product, we should increase or record a receivable. What kind of receivable? Preferably an account receivable. And we know by definition, account receivables are accounts we set up to receive cash in the future. And last but not least, adjusted entry number 5. Unearned revenues. So gang, before we get into the description of what an unearned revenue is, I just want you to know that unearned revenues sit on the exact opposite spectrum of a prepaid expense. What do I mean about that? Anytime in a transaction there's a prepaid expense occurring, the other opposite effect of that transaction occurring is an unearned revenue. So, what is an unearned revenue? Well, it's not a revenue. An unearned revenue is created whenever you receive cash in advance for a service to be provided in the future. Therefore, the revenue has not been earned. The revenue is actually what? Unearned. So unearned revenues that occur are not revenue. When someone gives the company cash in advance, that company now owes that person a service. And the fact that they owe that person a service means that an unearned revenue must be a liability. Unearned revenues are simply obligations of services to be provided in the future because they've already received the cash. And so when I was speaking earlier, anytime that someone pays for an expense in advance, a prepaid rent is created. But when they give that person that money in advance for that expense, that person who's receiving that money in advance has now created an unearned revenue. So there you have it, gang. A brief but detailed description of the 5 adjusted entries that must be performed at the end of a period before we create the financial statements. Now, remember I told you that these were monsters, right? Well, I'm going to deliver 5 individual videos that will break down each component of those adjusted entries. This video was simply to describe and give you a basic introduction about the 5. So if that light bulb was clicking and those brain neurons were firing, please feel free to like, subscribe, and share with your friends this channel for more ways to chase the bag with this accounting information. As always, gang, it's been my pleasure, and I'll see you soon. Bags!